The retiree portfolio is of immense interest to me to see how people are planning their retirement and how things have changed. So in the 70s and perhaps even in the 80s, many people had a assured pension. Okay, many of family members who retired somewhere in the 80s or even in the 90s had retired from government service, and most of them had a government pension, so which meant that they or even their wives didn't have to worry too much about from where their monthly expenses would be met. And these people had very simple lifestyle. So whatever pension they got, they had a surplus. They could save even from that. And I even now know of families where the mother's pension, which is the which could be the father's half pension or the mother's own pension, because many people of that age were also working. With that, they are able to run their family of 4 or 5 people. Apart from the old person herself or himself, their son or daughter's life also depends on the pension that is received. So that pension is very important. Now, pension as your retirement tool has ceased to exist for most of us, and for most of us in the private sector it was never there. Even for my father, he was in the private sector, so he had no pension. He had to create his own pension. Now what would people do? People would go and put money in bank deposits, National Savings Certificate, PPF would anyway be there, and that's it, or in company deposits, Mahindra Finance or HDFC. These were the non-banking finance companies which gave you slightly higher return than banks. So if banks were giving you 11%, these companies gave you 12%, and you could live with that, right? So that is how people used to live. Then came the time of the 70s, 80s and even 90s when inflation was very high, and that meant that people felt that the money that they had was not adequate. So they had there was a school of thought which said, if you have enough dividend income with which to retire, then you're safe, because you don't have to worry about inflation, because dividend will always so inflation eroded the corpus of fixed deposits, which means the interest was now no longer sufficient. So people said that we should have a dividend income. So people used to have dividend income, which people created an equity portfolio from which they could have dividend income. But please understand, given Indian conditions, dividend income is very low, payout is very low. So you could get only maybe 1 or 2% yield, and especially in an elevated market like this, I don't think you get more than 1% yield. So if you needed 10 lakhs a year for your expenses, which meant you needed a portfolio of 10 crores. Now that was beyond most people. Anybody who was middle class or slightly above middle class couldn't think of creating a 10 crore equity portfolio. So that was really out. So equity was not a very important part of retiree portfolio. Also because the markets constantly told you that equity is risky, you should not put money in equity. It sounds very funny, but then not putting in equity is also risky now with longer lifestyles, longer lifespans. So what is your choice today? You can't put money only in State Bank of India fixed deposit and get 3% return or 4% return. That's what you'll get. Going forward, interest rates might go down even further, so 4% return. So your return in equity is less than 2%, and your return in debt is going to be about 5% or 6%, maybe it will be 7%, so which means you need a huge corpus because yields are falling. So what happens is people start chasing yields, which is the riskiest thing to do, because higher yields means higher risk, so you need to take higher risk. So what can you do? Can you depend only on interest? Can you depend only on dividend? Answer is no. Or can you say, okay, it's okay for me to exhaust my corpus? No, at 78 years of age, you don't want to go and live with your children, right? You retired at 62 or you retired at 58, and at 78 you finished your corpus for whatever reasons. There was inflation, there was some unexpected expenses on medical which was not reimbursed by your insurance company, whatever it is. At 78 you exhaust exhausted your money, and now what is your option? Your option, if you have children, is to request that they let you stay with them. You will save rent, you will save money on some of the utilities, you save money on the buying the newspaper, right? You can save some money, but you'll have to live with your children if they're willing to accommodate you. If they not willing to accommodate you, what will you do? I have no clue. The other thing is to say, I will create a portfolio where I will have some money kept on interest, so that will give me interest. Some money will be kept in a mutual fund, which could be a debt mutual fund or a hybrid mutual fund, from where I will do a systematic withdrawal plan. Please remember, when you do a systematic withdrawal plan, a portion of your capital also could be coming back to you, right? So you have kept an X amount of money there from where you can draw on a monthly basis, and that is second one. And the third pillar is you should have an equity portfolio from where you are getting dividends. Right? So now what are your pillars? Your first pillar is interest. It always was. Your second pillar is a hybrid fund from where you're partially getting capital and partially getting the yield on the debt portion, right? So you're getting that combination. Remember, in a hybrid fund, you can go to zero if you withdraw at a more aggressive rate, assuming that your debt hybrid fund is giving you about 5-6% return, or maybe 8% return, but you're withdrawing 10%, right? So what will happen is, over 5 years, 6 years, the money will go to zero, assuming the corpus size that you have, but it is bound to go to zero because you're withdrawing more than the growth that is happening in the in the fund. Then you also have some equity from where you're getting dividend. Now what is your next important source? That is your capital gain. Don't be afraid to sell off an inflated asset. You have a house in Bangalore, sell it at a good price whenever you get a good price. You have a house in Coimbatore, doesn't matter. You have land in Chennai, you have land in Jaipur, you bought it long ago, it has appreciated, sell it. Don't be afraid of withdrawing a portion of your capital. You have shares which have appreciated, sell it, does not matter, right? So that has to be another leg of your cash flow requirement for your retirement. You have to have interest, you have to have you have to have dividend. These are two sources of income which keeps your corpus intact. Rent, you have property from where you are getting rent. These are known sources, perfectly all right. Use them. I mean, 5 lakhs for the husband, 5 lakhs for the wife, so 10 lakhs of income, if that is sufficient. If you need more, create more income, however you create this. And the fourth element is to withdraw from elevated assets. You have a house which has appreciated, sell it. You have equities which have appreciated, sell it. There is no harm in selling a portion of your equity assets and putting it into a debt fund or putting it into a hybrid fund from where you do a systematic withdrawal. That is also possible. You think the markets are high, do it. Or if you think that your corpus is now so much higher than you will ever require, then there is absolutely nothing to worry. Do your systematic withdrawal from your equity funds. That is also good, because at some stage, if the market falls, you stop doing that systematic withdrawal, do the systematic withdrawal from your debt fund. But don't think that capital should not be withdrawn. Capital should be withdrawn. As much as you can delay, it is good, but it does not mean it should not be withdrawn at all. Let's say you start withdrawing capital at the age of 76 and you die at the age of 86, and you still left a huge corpus for your next of kin. It's not too bad, but don't compromise on the quality of life. I know people who have funded their children's homes and now they don't have enough money, nor do they have the heart to tell the children that they need the money. It is their own money given as a loan, but turned into a gift by the kid by not repaying the capital. Don't allow such things to happen, because it is your capital. It should be available to you when you need it, not when your children think that they are doing you a favor by giving it back to you, right? Your money should be yours by right, and you can withdraw from your capital. 75 is a good age to start withdrawing from your capital, especially if your capital is huge, because even assuming you live till the age of 90, you still have 15 years in which you will withdraw, because your income will also be there. You're just supplementing a portion from the capital withdrawal. So don't worry too much about withdrawing from the capital. I think this video is very important for people who have senior citizen parents or friends or uncles or aunts. Please share this video for those people, because they are morbidly scared of withdrawing from their capital, and they live a very low end life, and they leave more money for their children than perhaps what they intended, and their children will go and spend it. They will eat out one day and spend more than what you were spending in a month on groceries, right? So don't do this. Of course, it's nice to leave money for your children, but it is far nicer to live a comfortable life for which you have created a interest as a cash flow, some kind of a hybrid fund which goes to zero, which means some capital appreciation is coming, dividends, and the fourth most important, booking your gains, maybe paying the tax and spending it on yourself. Far better than leaving it to your children who don't perhaps need it. Thank you.